The market doth not know all. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of August 9th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. First things first, you guys probably noticed the background behind me is... it's a little bit different, a little bit sparse. I am in the middle of a double move. I'm in a temporary location filming and recording this week before I move into my new apartment in Seoul. So bear with me. The technicals are a little bit different today. The acoustics are a little different. I haven't had time to balance everything out. And also, I'm only down to one camera. So I'm going to be doing a lot of today. So forgive me. If you didn't see my tweet or my YouTube community post, I'm sorry for missing a video last week. That was my first weekly update that I've missed since November of 2020, but it couldn't be helped. My computer and camera equipment were lost in the mail. They were being shipped to me and I didn't get them in time for the video, so yikes, sorry about that one. Anyway, the week was pretty interesting, pretty positive overall for investing. Most of the markets were doing pretty well, especially after the impetus that was the jobs report came out this week. It was much better than expected. Unemployment dropped off 0.5%. Jobs were better than expected. Non-farm payrolls. So we did have a little bit of a lift off there. Everything was doing pretty good. Also, it was a busy week for earnings. The companies that were reporting did well. No complaints all around. But anyway, let's get started with the news. First news story. Nikola's electric truck prototypes were powered by hidden wall sockets, towed into position, and rolled down hills, prosecutors say. We knew about the gravity-assisted trucks. We didn't know about the electric socket thing, so that's kind of interesting. Prosecutors said the prototypes didn't function, were Frankenstein monsters cobbled together from parts from other vehicles. Oh boy, it's getting juicier and juicier. The founder of the much-hyped electric truck manufacturer Nikola Corp has been charged with lying to investors about the supposed technological breakthroughs the company had achieved in order to drive up its stock price, federal prosecutors announced on Thursday. Trevor Milton, 39, is accused of claiming that his company had successfully manufactured working prototypes of electric trucks and pickup trucks that would turn the industry on its head when he had, in fact, never built anything. Well, not building anything is entirely different from building things that just are prototypes, so that's a pretty big accusation. But as we've seen with Nikola, we knew the commercials for the trucks were gravity assisted. They were pushed to the top of the hill and then rolled down the hill to make it look as though they were in motion. Also, in these acquisitions, we see reports that the trucks were towed into place during exhibitions, and then hidden plugs to wall outlets were used to power the trucks, to show the lights, to show everything moving and working inside. And also we had situations where doors were taped shut because there weren't even door latches on the doors. Yikes, this doesn't look good, but it's not surprising because Trevor Milton has a bit of a history of being a scumbag in business, so the fact that he lied about this, yeah, it kind of fits with the rest of what we know about him. Also this week, which shouldn't be very surprising, but Nikola has reported yet another loss with $0 in revenue on their earnings report. Well, yeah, I mean, they don't produce anything. They're not selling anything. Obviously, they have $0 in revenue. The earnings report's not really a big shocker, but it's just piling it on to the Nikola stock, and we're seeing negative price action in response to this on the chart. Here's the Nikola chart. We've had all the news about Trevor Milton coming out since the end of July, leading into the bad earnings report, and we've just kind of fallen off from a high of about $14 over the last couple weeks down to about $9.85. There's not much positive. The RSI is showing that the stock is oversold. The MACD is incredibly low, but in order for something to really be considered oversold, there has to be like a positive catalyst that could possibly drive the share price up. And I challenge anybody to tell me what the positive catalyst is for Nikola. I'll wait. I'm pretty sure there isn't one. I don't think there's a single positive catalyst for Nikola. It's just done. The fact that the company still has a market cap over $4 billion is just amazing to me. We're sitting here at $4.09 billion. The institutional investors, a lot of them are still in on the stock, even though it's been about a year now since Trevor Milton left the company and not much has happened in the company. I'm not sure why they're still holding. Maybe there's a legal reason for them to still have their shares. shares, but as soon as the institutions start dumping their stock, the share price, the market cap of the company is just going to tank. I think sometimes it's hard to just man up and take the L, and you're really hoping for a turnaround here, and I just don't see it happening with Nikola. Next news story, Robinhood surges more than 24% and blows past its $38 IPO price. This was cool if you're in on Robinhood. If you were following it from IPO week, it IPO'd at $38, promptly dropped off a cliff. Last week it ended up rallying, and it ended up soaring actually, at one point touching $80 a share before falling back off. Right now we're sitting around $55. So why, pray tell, might it have fallen off from 80 to 55? Well, Robinhood is a shady company. Remember, as I've been talking about, Robinhood retreats from monster rally this week as stockholders file to sell 97.9 million shares. The offering is through an automatic conversion of certain convertible notes. The stockholders were among those who came to Robinhood's rescue during the historic trading mania earlier this year, and the selling shareholders include a number of venture capital firms that invested in Robinhood early on. So that explains the sell-off. We've got a bunch of people who bailed Robinhood out. Remember when they had a liquidity problem, or I should say, in the words of their CEO, we don't have a liquidity problem, Vladimir Tenev, back in January when GameStop and AMC were shooting up. Yeah, sure, they didn't have a liquidity problem. They just needed an infusion of liquidity from outside investors. You know, if it walks like a duck and quacks like a duck, it's probably a duck. So they had a liquidity issue. These investors came in and gave the money to Robinhood that they needed, or loaned it, I should say. The moment they were able to sell their shares in Robinhood stock, they did. This ended up flooding the market with close to 100 million shares of Robinhood just a week after its IPO. It wasn't even just the outside investors that were doing this. It was the C-suite internally of Robinhood. Insider trading, the trends for the last couple of days of July. We've got insider selling shares on IPO day. We ended up immediately selling off 2.6 million shares, and there's been a lot since then. We actually, at this point, we have some directors, the CPO, sitting at 0 shares. They've already sold their positions, and you could go through all of the conversions, the exercises, the conversions from preferred shares, and the stock sales all the way through down to the bottom. And I mean, some of these sales are pretty major. We're talking tens of thousands or even millions of shares. Vlad Tenev, the CEO, even sold close to 2 million shares. That being said, he's still holding 51 million. The point is, C-suite wanted to liquidate their shares right away. The outside investors wanted to liquidate their shares right away. Not really sure why anybody's very bullish on this stock. It seems like it was a bit of a pump and dump here, where the price per share was just driven upward, and as soon as it hit a certain level, everybody's like, yeah, no, selling out, done, walk away. Still, I'm not going to touch this stock. I would not touch Robinhood unless it was below $30 a share. I would think about it, and I wouldn't even buy it unless it was between 10 and 20 a share. This is way overvalued, and the lawsuits are never ending. It is a laundry list of litigation for Robinhood, and I'm not confident for the future of the company. One positive story this week, AMD stock jumped to a new all-time high this week, climbing up to $122.48. This is a Motley Fool article. Typically, I don't like Motley Fool, but the reasons that they give for this are pretty solid, so I'll go ahead and accept them. There were 2 primary reasons for the stock climb. The first one I think is not as big of a deal, but AMD debuted its Radeon Pro W6000X series graphics processing units for Apple's Mac Pro desktop computers on Tuesday. The new chips offer a powerful performance boost compared to prior models and are expected to see strong demand from professionals who require advanced graphics capabilities. The bigger reason is down here at the bottom. AMD shares also appear to be receiving a lift from a report that the UK government might reject rival chipmaker Nvidia's pending $40 billion acquisition of ARM Limited, as British regulators are reportedly concerned about potential national security risks, according to Bloomberg. So AMD is acquiring Xilinx, and Nvidia was acquiring ARM. Both of these are direct competitors between AMD and Nvidia, and Nvidia's deal looking like it's going to fall through as the British government steps steps in to intervene looks better for AMD from a business standpoint. Like AMD can actually close the acquisition, can get the business done, and it gives investors a lot more confidence. Plus, AMD just had their earnings report, and CEO Lisa Su again is like a BAMF, and the earnings were stellar. AMD, meanwhile, is already firing on all cylinders. Its revenue and adjusted EPS soared 99% and 250% respectively to $3.9 billion and 63 cents in the second quarter. We're growing significantly faster than the market with strong demand across all our businesses, the CEO said in the company's earnings release on July 27th. So here we go. AMD's beating the market in earnings, beating the market in growth, successfully closing on the acquisition with Xilinx. Everything looks good for AMD. And I've talked about this stock a lot on this channel. I'm really bullish on it as a semiconductor stock. The share price has responded appropriately, gaining over 30% in just the last couple of weeks. AMD, for a really long time, we were stuck in a channel between about $70 and $90. This run up over the last couple of weeks has brought us from 84 up to a high of 122.48, and since then we've been consolidating a bit down to 110, 109.80 after hours. The chart looks pretty interesting. You could see AMD's high volume during the first 4 hours of trading each day. Spike, consolidation, spike, consolidation, spike, consolidation, spike, consolidation, all the way up and back down. So one thing that does show us here during this AMD rally is the big buyers, the big movers are coming in, moving the price early in the morning, and in the afternoon there's a little bit of a waning interest, a bit of a cool off. So people are planning these moves overnight, pre-market, and then getting their purchases in, which is kind of a bullish sign because it's almost like they don't really care about the price action. They're just establishing positions no matter the price in the first half of the day. And it's not very common that we see this type of movement so clearly for days on end on a stock. Another story that I wanted to cover had I been able to do a video last week is that Amazon stock loses $130 billion in market value after $885 million fine and a disappointing earnings report. Shares of Amazon fell as much as 8% on Friday after the e-commerce juggernaut disclosed a massive fine from European regulators for allegedly breaking regional privacy laws and posted second quarter earnings results that failed to meet Wall Street expectations, putting the longtime market leader on track for its worst day in more than a year. To be clear, this was actually Amazon's worst drop since the COVID drop as far as a percent of its PPS per day. If we go to the Webull chart, we could see right after the earnings there was a huge high volume day, and Amazon the day before closed at almost $3,600, and the next day we opened at $3,344. Though we rose a little bit last week, we're actually down even lower at $3,344. So even though I was not able to cover this stock last week, it's not really a huge deal because it seems as though the price has still been declining. The earnings report, to be clear, wasn't bad. They missed on revenue by a bit. They missed on earnings by a bit. They weren't huge misses, but the problem is the enrollment and e-commerce users are actually declining as the economy returns to normal, as people go to brick and mortar retail stores to shop once again. But this is something that should have been expected, and I'm surprised about the sell-off. We knew that this e-commerce boom wasn't going to be a forever thing. Yes, it's going to increase going into the future, but the boom was a bit artificial because everybody was stuck at home during lockdown, during COVID. So the fact that it's just returning to normal is just normal, I guess. I don't know what else to say. I don't really agree with the sell-off. It should have already been priced in. We talk about things being priced into the market all the time, but I guess it wasn't this time. The market doth not know all. Also this week, we did have the Bureau of Labor Statistics from the U.S. Department of Labor releasing the jobs report. The total non-farm payroll employment rose by 943,000 in July, and the unemployment rate declined by 0.5 percentage points to 5.4%. This month, we had the double boon of an increase in the number of jobs past what was expected and a decrease in the unemployment figure. Notable job gains occurred in leisure and hospitality, local government education, and professional and business services. Now, a lot of this is expected. Summertime in America is travel time. A lot of travel restrictions, a lot of COVID restrictions have been lifted. Americans are still having a hard time traveling internationally, as with anybody, because there are different restrictions per country, but domestic travel is a very popular idea this summer for many Americans. With domestic travel comes domestic travel hires, and hospitality and leisure type jobs open up to prepare for the summer season. So there is some some seasonality here, even though it's non-farm payroll, with the hospitality and leisure sector, and this could possibly be artificially inflating this number. We might see a little bit of a dip come August or September, but there's going to be something else compensating for that I'll talk about in a moment. Now, also, we have local government education jobs here. This would be your county school board, your state school board, hiring administrators, hiring teachers, hiring paras for the upcoming school year. Most of you know, American school years typically go from sometime in August or September to sometime in May or June, and they're off for the summer months. So this is the time when a lot of the schools and the school boards are doing their hiring for the next year. We saw this last month on the same jobs report. It was the same sectors leading the gains with hospitality and leisure, local government education. And both last month and this month, we've seen numbers over 900,000 beating expectations. The unemployment rate declined by 0.5 percentage points to 5.4% in July, but this remains well above the level prior to COVID at 3.5%. So we're still almost 2% above the levels for COVID. And if you've been listening to Jerome Powell talking about the Fed, talking about increasing rates, he doesn't want to do it until employment reaches around that 3% figure. So the employment number is incredibly important for determining when the Fed is going to aggressively move the interest rates up to combat inflation. Until we get that unemployment figure down to about 3%, there's not going to be much of a move. If this trend continues and these employment rates keep going, then we actually might see something close to 3% by December of 2021. Now, does that mean they're going to automatically increase interest rates? No, obviously they're going to taper them. Otherwise, that would be catastrophic for the market. It's going to be a gradual thing, but it could move up the timeline for when that tapering begins. Also, we have another kind of catalyst for this coming up. At the end of September, most of the federal unemployment benefits are ending. And right now there is a jobs shortage on the market, and the widespread sentiment is that people are choosing to stay on the federal unemployment benefits and collect that government money instead of getting a job. Now, the reasons for that are a complex issue that I don't feel like going into, but it could be that employers simply don't pay enough, the government is paying enough to combat the desire to go back to work, or the jobs available to these people, simply put, are just minimum wage jobs, so they would rather sit at home and milk the government money as long as possible. I don't really blame the people. I don't blame the government. I think it's a very complex issue. It's multifaceted, and I could definitely see arguments both ways, but the simple fact is right now these unemployment benefits are scheduled to terminate at the end of September. So once they're terminated, you're going to see a rise in October on that jobs report of the number of jobs. Next news story, Square just reported their earnings, and they're also going to be buying AfterPay for $29 billion to tap younger users. Sidebar media, please don't say this. Tapping younger users sounds awfully euphemistic, and somebody gonna get in trouble. Square Inc., the digital payments platform led by Twitter Inc. founder Jack Dorsey, agreed to buy Australian buy now pay later company Afterpay Limited for $29 billion in its largest ever acquisition. The all-stock offer values Afterpay shares at 126.21 Australian dollars, 31% higher than Friday's closing price of 96.66 Australian dollars. So Square is going to be acquiring Afterpay for a 31% premium off of its shares upon the announcement. This is kind of a big deal because this is Square's foray into the buy now, pay later market, which is rapidly proliferating throughout the rest of the world, lagging behind a bit in America, admittedly. For those of you who are not familiar with the buy now, pay later system, it's effectively a type of credit where a financier cooperates with a retail location. Let's say a consumer wants to purchase a retail item for $600. $600 for many people is a very large purchase to make all at once. So they could put it on their credit card and then have to pay monthly interest payments, increasing the price of the product overall, or they could use a no interest rate buy now, pay later system where they divvy up that $600 into to 4 months of equal payments of $150. So how does that financier make money? How does a company like AfterPay make money? They end up working with the retailer, where the retailer gives them a cut of the sale price, because the idea from the retailer is that more consumers will buy the item if it's made more affordable through the buy now, pay later system. And this has already been proven effective through the Australasia region, where buy now, pay later has been used already for many years in Australia, New Zealand, Singapore, Hong Kong, South Korea. Hell, I'm moving into a new apartment. I just bought a new YouTube camera for my studio. I bought my bedding, my furniture, all on buy now, pay later, where I split the payments over about 6 months with no interest rate. So it's a really fantastic system, and it's taking off in the EU with Klarna, and I think Klarna is starting to move into the US market as well. We have PayPal offering a buy-in 4, which is, I forget if it's a 4-week or a 4-month system, but it's effectively a buy now, pay later. There's some other companies like Split and a bunch of others that I'm forgetting. Apple and Affirm are joining on a buy now, pay later system for Canadian purchases. Apple Inc. and Affirm Holding Inc.'s PayBright are planning to launch buy now, pay later program for Apple device purchases in Canada, stepping up the iPhone maker's ambitious offer of more financial services. Now, we've already seen this from Apple with their Apple Card, with Apple Pay. We've seen Apple dabbling into the financial field, but the buy now, pay later system with PayBright through Affirm is another way for them to do this. Now, another way that these financiers, these companies like PayBright, like PayPal, like Klarna, like AfterPay make money is with, of course, late fees. Now, I don't want to say that buy now, pay later is a perfect system. It still has some predatory aspects like credit card companies, but credit card companies will eat you on the interest rate and then they'll eat you on the late payments, whereas buy now, pay later systems will only eat you on the late payments. So as long as you don't make the late payment, then there's no downside to using the system. Buy now, pay later systems, for the most part, only run soft credit checks, not hard credit checks, so they don't even show up on your credit report when you sign up for the service. So all in all, it's a pretty solid system. Now, I found this cool article, Why Millennials and Gen Zs Are Jumping on the Buy Now, Pay Later Trend. Buy now, pay later platforms that allow customers to make purchases in installments are growing in popularity in the US. Younger generations are hopping on the trend to save money, buy clothing, and keep up with their peers instead of using traditional credit cards. Oh, okay. I read the rest of the article. I'm just going to summarize it for you. Millennials and Gen Zers, they're broke. They broke. They're like most people, and they're struggling for money right now. One of the things that they still want to do is keep up with consumer culture, keeping up with the Joneses. You got to buy what your neighbors have, buy what your friends have, participate in consumer culture. So buy now, pay later from like a macroeconomic standpoint is a great thing because it's allowing the propagation of consumer culture, which is just going to further drive the stock market up. Economy ho! Yeah, so that's real exciting. Anyway, they got to get their Starbucks and their Apple MacBook Pros, and you know, buy now, pay later is a pretty good option for that. A couple weeks back on my last video, I talked about the Valero Energy earnings report, and Valero Energy had a stellar earnings report for the reasons I expected. The increased oil price ended up causing them to beat their expectations bigly. The thing is here, I didn't actually end up going through with the options purchase. I went ahead and tweeted about this, and I posted it as a pinned comment, the top comment under that video, because the share price shot up $2 per share pre-market on Monday morning. This drove the options prices up over 20%. I was not comfortable enough with that margin to go ahead and make the options purchase, and I strive for transparency on this channel, so I wanted to let you guys know that I wasn't going through with it, hence the tweet, hence the pinned YouTube comment. So I did not go through with this. However, that doesn't mean that it was a bad decision. The people that did go through with it still made money because the share price went up even higher than I expected. It ended up touching $69.50 that week. Let's take a look at the upcoming earnings for this week. Guess what? It's meme stock week. Yeah. We've got meme stocks everywhere you can look. I can't even name them all. Workhorse, AMC. Coming in here on Tuesday, we've got Fubo and Coinbase and PubMatic. We're going to talk more about PubMatic as my options play for a week. Wednesday before open, we've got Wendy's. Make your tendies with Wendy's, Clover and Neo and Hyliion, Coupang, Korea, Boo. There's a lot of different stuff here. Lordstown Motors. Oh boy, I can't wait to watch that catastrophe unfold. Thursday, we've got Palantir, we've got Wish, Airbnb, Rocket, SoFi, Sundial, Tattooed Chef. These are all what some people would consider meme stocks. On Friday, Lion Electric is another one. All throughout the week, we've got meme stocks galore. On Tuesday, it's not on this chart, but Shift is reporting on Tuesday, so I'm looking forward to some Shift earnings. You guys know I'm really expecting a good earnings report here for Shift, with the inflation numbers driving used car prices as high as they were for the second quarter. Personally, I'm going to go on record right now and say I'm going to expect the highest revenue ever for Shift on its earnings report, and I'm also going to be expecting its highest ever gross profit per unit, which is the metric used car sellers use for their profitability. I'm expecting good things this week for Shift. But for the options play of the week, I want to take a look at PubMatic. Now, this is not perfect because the volatility is really high and the industry leader in the digital ad space, the Trade Desk, isn't reporting until pre-market on Monday. If I decide whether or not to go through with this PubMatic play that I have planned out, I am going to tweet about it on Monday morning after I see the Trade Desk earnings, before I decide whether or not I'm going to make this play. What's the play? What's going on? PubMatic is a supply-side cloud digital advertising solutions provider for companies to get their targeted advertisements to the customers that require them. In this ad space, we have several companies. One of them, Kubient, which is the smallest. I covered it in a DD video a long time ago. Kubient bag holder right here. I'm still confident in that company because the space is growing. I just think I picked the wrong entry point. Regardless, the Trade Desk is the big winner. They just did a 10-for-1 stock split. Their stock was trading at something like $700 a share. Now it's back up to like $80 a share, somewhere thereabouts. We have Magnite, which is another supply side platform. So Magnite's a very good analog for PubMatic. Magnite reported last week, which is the direct analog to PubMatic. Their second quarter revenue crushed expectations. Forward guidance was better than expected, and CTV, connected TV, continues to look like a promising opportunity. Magnite, which provides supply-side platform for publishers, posted soaring revenue growth of 170% to 114.5 million, which easily beat estimates of 94.1 million. If you can't do math, that's a $20 million beat. That's big. That's over a 20% increase off the expectation. One of their big benefits was the acquisition of SpotX, which is a CTV specialist, back in February. And their CTV revenue more than doubled to 34.3 million. Now, for their forward guidance, they're expecting revenue of 112 to 116 million compared to analyst estimates of 107. And it also sees 41 to 45 million in CTV revenue, excluding the impact of the SpotX acquisition. This is going to be a little bit higher. So we're looking at about 50% of the revenue coming from CTV. Remember that number, about 50% of the revenue coming from CTV. We also had a big CTV company report earnings last week in Roku. Now, Roku delivered strong Q2 earnings. Their revenue is up 81%. Their total net revenue grew 81% year over year to 645 million. Platform revenue increased 117%. Gross profit up 133%. Blah, 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 blah. Really great stuff. Beat expectations. If you go to the actual investor presentation for Roku on their earnings report, you can see that CTV, Roku, is beating traditional TV right now with viewing hours at 19% gain compared to traditional TV being down 19%. One of the big drivers for Roku's success is the ad business strength. In Q2, advertisers continue to follow audience and move budgets into TV streaming. Roku's monetized video ad impressions more than doubled year over year. Our competitive advantages in first-party customer relationships, data, ad innovation, ad technology help drive this growth. This is big. We're pleased with our progress increasing the number of small and medium-sized businesses on our platform, as the number of advertisers outside the Ad Age 200, the top 200 companies, grew over 50% year over year. Already now, we have Magnite showing huge gains, 50% plus gains in CTV. We have Roku showing really big gains, doubling their ad spend from companies, their ad revenue from companies coming in. And we've got PubMatic being a platform similar to Magnite that caters to CTV clients. This is on PubMatic's last investor presentation. They have strong revenue growth across channels in Q1 2021, so this was last earnings report. They had sequential CTV revenue growth, the connected TV services similar to Roku, revenue growth of 55%, which is even bigger than Magnite's. When you put these things together, it looks like PubMatic has the possibility of an absolutely explosive earnings report this week, blowing guidance out similarly to how Magnite Magnite beat guidance by almost 20% on its revenue. It's not all rosy. If we look at some of the metrics for PubMatic, the implied volatility is 120.5%, but the historical volatility is 61.89%. This is a very volatile stock. There's a couple of reasons for that. One, the float is incredibly low, as we'll see in a moment, but two, options didn't come available until the beginning of the summer for PubMatic. So we've only been dealing with options prices for a little over 2 months here for PubMatic, which means there hasn't been a settling period. There hasn't been a normalization of buying and selling. There's currently a bullish trend on calls being purchased for PubMatic where people are expecting the price to rise. Down here, we can see the analyst rating earnings estimates. It's a strong buy based on 7 analysts offering recommendations, 5 strong buys, 1 moderate buy, 1 hold. Now, if we take a look at the chart here for PubMatic, we could see we're in a definite downtrend channel, but you can also see we're drifting towards the top end of the channel. And on the last day of trading, it kind of touched the top side of the channel where it looks like it wants to break out. Here's the interesting part. PubMatic only has 20 million shares outstanding, and it only has 7.44 million shares of float. There's 75% institutional ownership here. The short float is 35%, and the average daily volume is 1.3 million. So if we have a percent float shorted of 35% and a float of only 7.44 million shares with a daily average of 1.3 million shares, guess what? That takes shorts almost 2 entire trading days to cover. I hate short squeezes. I think talking about short squeezes is dumb. I think investing on the basis of a short squeeze is dumb. But when you have a company that has a very real possibility of blowing its earnings out of the water based on industry trends, when that company only has a float of 7.44 million shares and 35% of those shares are already shorted with 2 days to cover, you cannot discount that possibility of it playing a factor into the investment thesis. And I feel gross even saying, I feel like, ugh, oh God, I need to shower. I feel disgusting talking about a short squeeze here. But when you look at those numbers and the fact that PubMatic has appeared on the failure to deliver list a couple of times already in July, there's something here. There is something here. Take a look at the Magnite chart after their earnings report. They ended up skyrocketing here. We went up 8% after the earnings report. PubMatic had a similar move after the Magnite earnings report, but theirs was about 7.5%. So perhaps some of this is already priced in. You do have to consider that. The MACD is pretty low, but it's uptrending. The RSI is a little bit high, but it's downtrending. Of the 8 analysts, 2 are strong buys, 4 are buys, 2 are holds. We've got a current price of $31.97 a share, 32 after hours, and the low end projection is for 40, the high end projection is for $64 a share in the next 12 months. PubMatic has not been traded that long, but we already have reached a high price of $76.84, and that's back in March. The options chain for PubMatic is not very well developed. You can go out to 2022 for some leaps. I think that's unnecessary with the IV. The cost on those leaps is way too high. So instead, I'm looking at October. October puts us about 68 days out. And I want to get something, since I'm going out to October and I'm pretty bullish here, around this $35 level. And I realize this is a little bit out of the money. I don't want to reach to the 40 and I don't want to pay for the 30 right here. So I'm looking right here at these $35 calls, 68 days out on October 15th. Now, one of the other reasons that I'm going for this October 15th date is because it's about 3 months from PubMatic's appearance on the failure to deliver list. And what we've seen over the last couple months is once companies appear on the failure to deliver list, about 3 to 6 months later, you start to see these huge stock increases, these share increases. And the failure to deliver list is usually associated with these heavily shorted companies. So I'm thinking that PubMatic has a huge amount of volatility right now. We see that 120% volatility, but I'm also thinking there is the possibility of a massive price swing here off of a big earnings beat. To be clear, this is a gamble. This is a risk. This is a heavily shorted company. Now, institutions know why they're shorting things. They look at the metrics here better than I ever could. I'm not a professional. What I can see is their last earnings report reported positive net income. Was it much lower than their market cap? Yes. But was it positive income? Yes. They have been showing progressive growth, progressive improvement. I can see industry improvement. I can see a direct competitor, Magnite, improving its scale, improving its service. I can see clients like like Roku. Now, to be clear, Roku is not a client of PubMatic that I am aware of, but it is a CTV company. I can see them reporting higher ad spend. Everything looks good here for PubMatic from a macro scale, and that makes me interested enough to take a fleer on this. All right, everybody, that is it for me this week. I hope you enjoyed the video. As always, if you want to support the channel, check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins because I'm partnered with Webull. The free stock that I'll be getting is worth $30 or higher. Also, if you enjoyed the video today, please like the video, subscribe to the channel if you want to be alerted to all my content as soon as it goes live. Make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe, happy investing. I will see you next week in a new location with a better camera, with better autofocusing, so my handsome face is going to be a little less blurry. See you guys later.